So, you are at a point in your life where you are considering investing a portion of your money for various reasons, whether it'd be for your retirement in 10 to 20 years or your kids' future college expenses or just to protect the value of your hard-earned money. Either way, you want to learn how to invest, and the different options that are available to you. Maybe you heard on the news about Tesla or Apple, and that if you've invested 10 years ago, you'd be a millionaire by now. This whole investing thing can seem complicated for you if you are new to the game. You might have questions like, how do I invest in a company? How do I buy a stock? What is a stock? Do you just go to the company's website and buy some shares? You get all these acronyms being thrown around like Roth IRAs and 401k in the US, or like TFSA and RRSP in Canada. And all the stress that's generated by the risks that goes with investing, the fact that we don't want to lose all that money. So in light of all of that, here's a simple guide on how to start investing. How does investing works? In simple terms, you want your money to make more money over time, because if you don't do anything with that money, it will lose value over time, thanks to inflation. Think of it this way. 35 years ago, a Big Mac from McDonald's would have cost you about $2. Today, for the same burger, you'd be paying around $5.50. That is inflation in action. Inflation is usually about 2 to 3% on average annually. Except this year where we are seeing inflation as high as 9% year over year. Let's say for example you have $100 and you decide to stash it somewhere for 10 years without touching it. In 10 years' time, your $100 would be worth less than the original value because its purchasing power would have decreased, as the price of goods and services would have increased by about 2% each year. So if we say that inflation will be at 2% every year for the next 10 years, hopefully, then your $100 will only be worth $82. You will lose money over time, and this is obviously not good. So what can we do to avoid losing that much money over time? Well, we invest. But how? Where? We can invest our money in a saving account, which is deemed to be a very safe investment, but we typically only get around 0.5% return. We are still losing money adjusted to inflation. I personally do not call this investing. We can also invest in the stock market and get a return of about 10% on average every year. But it's riskier than a saving account. Investing in the stock market is basically buying a portion of a company in the US or anywhere in the world. Let's take for example your $100, but this time you decide to invest it in shares of a company you like in the hope to get at least 10% return on your money every year. The idea here is that when you buy a share, you are buying a part ownership of the company that you've got the share in. So you decide to buy 100 shares of Company A at $1 a share that's valued at $10,000. Now you own 1% of the company. 10 years later, Company A did great and is now worth $25,937.42. Remember, you own 1% of the company that's now worth $25,937.42, which translate to $259 if you decide to sell. So basically, you more than doubled your money by investing in Company A without doing anything other than waiting 10 years, which is pretty awesome. This way, if we adjust to inflation, your $100 would have grown 8% every year to $216 for a total of $116 capital gain. Another form of investment would be investing in a dividend company, or a company that pays you monthly or quarterly to invest in it. Let's take for example Intel that's selling for about $25 per share at the time of the recording. So you'd be able to buy 4 shares of Intel at this price for a total of $100. In return, Intel will pay you about $1.46 per share you own for a total of $5.84 every year, just for investing in them. And on top of that, if the company performs well through time, and if you hold on to it for long enough, you could earn a nice capital gain when you decide to sell, just like the previous example with Company A. So in sum, investing is the process of buying assets, shares of Company A or Intel in this case, that increase in value over time and provide returns in the form of income payments or capital gains. Of course, you have to keep in mind that gaining from the stock market is never guaranteed, and you should always invest money you don't need for basic living expenses. At this point, you've probably got some questions, like how much money you need to get started? Or, how risky is buying shares in a company? I'll get to that, but first, let's try to understand how to buy a share, because it's not as easy as buying something from Amazon. Instead, you have to go through a broker, or the middleman. You might ask, what is a broker? It used to be a person you would call on the phone, and ask him to place an order on your behalf for some shares in Tesla, for example. Nowadays, we don't have to talk to a person to place an order. We just have to open an online account with a broker, and then you can buy shares in a company through that. In the US or Canada, for example, most banks do have their own online brokerage. So with most banks, you can also open an investment account and then invest online. Now that we know where and how to buy, you might be asking yourself how to decide which stock to buy? Well, this one is a big and complex question. You can go down the path of a stock picker, which will require you to put in the effort and do a lot of research to understand and value a company, and this might take you hours and hours, if not days of work, before you find a good investment. Or, you can invest in an index fund, which is kind of a basket full of companies, and it's designed to create a portfolio of stocks diversified in the way to replicate the performance of a financial market index, like the S&P 500 for example. They are known to be the best, safest and easiest long-term investment strategy for most people. Okay, I slowed down a little. What really is an index fund? They are investment funds that follow a benchmark index such as the S&P 500, which is the 500 biggest companies in the US, or the Nasdaq 100. When you put money in an index fund, that cash is then used to invest in all the companies that make up the particular index, which gives you a more diversified portfolio than if you were buying individual stocks. Let's use the S&P 500 as an example. It is one of the major indexes that tracks the performance of the 500 largest companies in the US. Investing in an S&P 500 fund, one of the most popular, means your investments are tied to the performance of a wide range of companies. For example, you can invest in VOO, which is the Vanguard S&P 500 ETF, and has a very low expense ratio of about 0.03%, and holds the 500 biggest companies in the US. Having said all that, there are other ways to invest your money, depending on your financial situation, your motivation or your expertise. You can invest in real estate, like buying a rental property that could generate your rental income, or buying an existing business, or start one. But these investments are not passive investment, as you would need to put in the work to generate that income. The best passive investment for most people, in my opinion, and this is not financial advice, is consistently investing in an index fund until you hit your magic number for retirement. This is the best investment strategy, as it has proven in the past that it could outperform the majority of other types of funds that are actively managed by top investment firms. Even the greatest investor of all time, Warren Buffett, has long advised that buying an S&P 500 index fund is a smart approach for most investors. Please keep in mind that I am not a financial advisor. I will only share my opinions with you, and you should always do your own research before investing. There you have it, guys. If you have found some value, please like the video and subscribe to the channel for more content in the future. Thank you for watching, and until next time.